next session will be starting any moment from now. Our panelist, Mr. Osayi, will be joining the call any moment from now. So uh, Osayi is going to be talking to us about AI venture funding. That is, how can you turn your artificial intelligence idea, your machine learning idea, how can we turn them into products? Wura, for those who were on the session, poster session yesterday, I mean, it was really, really, mind blowing. A lot of wonderful application of AI to agriculture, to security, to different social problems in Nigeria. And we can already see how that community members are solving this, solving these problems by using artificial intelligence. So stay glued to your phone. Any moment from now, Osai will be on the call and is going to be telling us how can we get funding for that big thing, that big idea you have concerning artificial intelligence
That
application.
that okay, I think that session is perfect. Michael and Sean, that's definitely from the business team. It's their thing, and I'm sure they're excited about it to learn more about what to do. Please stay on this channel. You don't need to log out. I can see some questions about that. I can see a question about LinkedIn being premium. Don't worry, you don't need premium LinkedIn to reach out to him. Please type his name on LinkedIn. He uses his real name on LinkedIn. You're going to find that. Just send the request. Okay, he's answering already. Okay, Michael, are you back online?
Yeah, thank you, Wura. I'm online and I'm very excited about this last session, and we look forward to the session with Osai.
Michael is there. Michael, so this is their session. Oh,
Great, great. So Mike, Osai will be joining us very soon. I think he's trying to connect. I mean, for the audience, for the attendees who are on the call, the interesting thing is, Osai is coming with a lot of experience when it comes to venture capitalists. He works with a venture capitalist organization, and his interests, all right, the interest of his organization is really to, support startups that are bringing up innovation, bringing up some very wonderful innovation around the application of AI to solve, complex problems. So this course, or let me say this session is going to be like your mini MBA for those of you who are interested in, having a good background of, business as to how you can apply, business to your artificial intelligence knowledge. So I tell you, it's going to be an awesome session. So please don't leave the call. If you are part of
oh,
the session, it will be starting shortly.
okay. Michael has been in business. So Michael, while we wait for Sai, do you think many people are prepared for the business side of things in tech? Do you think we are prepared?
Yeah, thank you, Wura, for that question. I think a lot of people are not really prepared for the business side of things. Looking at, and that is one of the great opportunity the DSN Bootcamp is availing everyone, all our participants today, to give them that idea that beyond just learning the technical skills, if you want to found a business or start a business in the area of data science, you want to work in an organization, you want to raise funds for your existing business, and you really need to learn these things because you're going to be balancing these things in the real world. And that is what our next speaker will be exposing us to. So while a lot of people are not prepared at this point, it's fine not to even be prepared at this point, but it's good to just acknowledge that state we are all in and see how we can learn from people that have gone through this path, people that are up there working in venture capitalist organizations. They can tell you this is how to assess top opportunities in terms of funding, in terms of even job opportunities for your business, international jobs and local jobs. How can you play in that space? How can you take that your data science idea? During one exciting thing I saw was during the paper presentation yesterday. I saw a
Mhm.
whole lot of exciting presentations came up, a whole lot of great ideas, and I think those ideas are awesome. That can be converted to very good businesses. I think you agree with me on that.
But Michael, I'm speaking for technical people now, for all the techies and all the tech bros in the world. Do you do you think our ideas are usually practical? Like, and why do you think people get angry when you tell them that the ideas are not exactly practical? Because I know you've jotted hackathons, people have shared their things with you. Why do you think people get angry when they say their idea is not marketable yet?
Okay, I think a lot of people do not understand the concept of business. In essence, they are trying to build, or they developed an idea and they want to be the users of that same idea. In building a business or in developing
Okay,
an idea,
sorry, Michael. I like the last phrase. I hope that is captured. This is me pressing rewind. You want to build an idea and you want to be the user of that idea.
that
You want
idea. Yeah. So in essence, people are not looking, you are not looking at the user's perspective. And there is a new level of thinking or a new way of doing things today, which is called design thinking. I know many of you must have heard about that terminology. If you've not heard about it, you can just Google it out. And that is when you are building things from a user's perspective. So if you say, oh, your idea, you have a fantastic idea, brilliant, you've done great research work, and you want to put that together and you want to take that to maybe funders, maybe raising investors, or maybe going to the stock market to raise some funds, or even looking at how banks, typically Nigerian banks or loan organizations, can support that your business. I think you must look at it from, because one of the things they would look at is how scalable is this idea? What is the commercial impact of this research work or this body of knowledge you've put together that you want to commercialize? How many people will need it? It is not about you. You have brought up a very fantastic idea, but there are some people that would need to use these things. How many are there? If the people that are going to use your solution are not more than 100,000 or 10 or 5 or 200, nobody's going to want to invest their money in that kind of business, because it's not scalable. It will not give the return on investment. And that is what tech people in general should start learning, that one opportunity tech gives you is the scale of your impact. A single tech product can reach billions of users. You can see with the advent of Facebook and even all these tools or software we are using, Microsoft tools and the rest of them, just one software solution can be replicated to billions and billions of users. So tech gives you that scale already. So you must look out for what is the thing that I can design or the solution I can come up with that can reach more and more and more people out there. That is what gives your solution the breakthrough you need, and you can blow, as we call it
Awesome.
in Nigeria.
Wow, I like that. You can blow. I mean,
no. If you think
okay.
of your idea scaling, okay, Leko, we're back online.
Yeah.
Mr.
So
Sai is
exactly,
here.
exactly.
Okay.
So Mr. Osayi is on the call now. Guys, like I said, like we mentioned, this is going to be like your artificial intelligence MBA course. So just go look for your writing materials and make sure that you make notes, because you would so much love this session. I'm talking about Blue. Just 1 minute. Talking about Blue, Awura, I think Michael has already captured it well. So Osai is going to be telling us how to really, really blow. So welcome once again, Mr. Osai. Good to have you on the call.
Thank you so much. You can hear me okay?
Yeah, loud and clear.
All right.
Yes, we can hear you.
Hello, everyone. Hello, morning, afternoon, evening, wherever you are. I'm super excited to be back here to be part of this community again. We thought it wouldn't happen, but thankfully we pulled through and we're having it today. Are the slides going up?
Yes, please. You can project your slide.
Oh, okay.
Yeah.
Okay.
Or do you prefer I project from here?
Yes, I do, if that's
Okay.
possible.
Okay. All right. Okay. I'll do that. Just a minute.
Yeah.
Okay. It's coming up any moment from now.
Okay. All right, brilliant. Let's get into it. Okay, so hello again. Hello, everyone. Today we'll be talking a little bit about some emerging opportunities in funding your AI startup. And we can move on. Okay, what we're talking about today, we'll start off with a little bit about me, share who I am, and why I'm making all this noise today. And then we'll go into talking about what the funding landscape looks like and what popular sources are available to anyone looking to raise some funding for their company, and finish off with what investors look for and how you want to position yourself to make sure you secure the bag and raise that funding. So a little bit about me: managing partner at Ripple Venture Capital, which is an early stage firm based out of San Francisco, leading seed investments in African deep tech and applied AI companies. I am also an angel investor in fleeting and nano VMs. I was previously the startup director at One Valley, which is really leading the startup unit of the Innovation Center. At the time, it was the second largest innovation center in Silicon Valley. And we had a bunch of good stories, and these are a few of them. InfoChimps was acquired by CSC, and Private Core and Nascent Objects were both acquired by Facebook, which is really exciting. If you know me, you'll know I'm the biggest fan you've ever found. Formula One, love Formula One, love swimming in the ocean, and I love strawberry cheesecake, yum yum yum. Fun fact about me is I once unintentionally kicked a shark, and we can go into that story if we have time later on. So some popular funding sources, and when you're starting out, you really want to, avail yourself to as many or all of these if possible, because the process is hard and you're competing with so many other founders. For even if the money seems like it never seems to run out, it is fairly limited. And one of the easiest ways to get started is by bootstrapping, just, not raising from external sources, but either getting a side gig or consultant work or getting a job. Or some people like to raise from, that rich uncle, that rich aunt, if you have, or some more wealthier friends, if you have. Another approach that founders take is applying for grants. That takes several months, but hey, it works. And going and participating and winning startup competitions. And then there's the alternative of raising funds from from people through crowdfunding. So from platforms like Republic and Seed Invest. I think they will require that you incorporate as US companies, but that's also something you might want to look at. But the single best way to raise some money is through your customers. It's through generating revenue and possibly profit. And you want to get to that point as soon as possible. You want to do everything you can to get to this point as soon as possible. Another avenue that startups take is going through accelerator programs. So Facebook and Google both have accelerator programs, and both have fantastic accelerator programs, I might add. And they give equity-free capital, which is great. So they don't take a chunk of your company. They give you money and they help you grow. They help you reach that product market fit. To validate that you have a product that people want to pay for, help you work with you to secure that first one or two customers, generate $50,000 or more in revenue. Fantastic path. And then, of course, finally, is the investor route. So either angel investors or full-on VCs. Angel investors invest their own money, and typically do it in groups called networks. One of the more prominent ones, the most prominent one on the continent is the Lagos Angel Network. You can go to ABAN, the Africa Business Angel Network. Go to the ABAN website to learn about other angel networks in other countries. So you can, because most of these angels prefer to invest in companies within their country, within their locale. And of course, it's also venture capitalists. And which brings us to the next topic, which is raising money. Being a company in Africa raising money is a great thing today, because Africa presents a really attractive opportunity for investors to invest for returns and impact at scale. And you see this with data that's from the past few years, and these are numbers showing the level of activity going on. And we're looking at the top 5 investors doing 7 deals in 2019. And these are all numbers that have grown from previous years. So while still nascent, it's on the up and up and fast. So if we go on, move forward, we can see that over the past 5 years, investing in Africa continues to shatter record after record. And this is why I'm saying right now is a great time to build a company in Africa. Yes, these numbers may have dipped because of the pandemic, but you can bet your bottom dollar that these numbers are going to go back up again. So we're seeing a record of 2 billion in funding amounts, and this is the breakdown of I know you can go back what it looks like. So we're seeing so if you take a look at the blue line, that's the seed line. That's probably where a lot of people on the call are looking towards, raising seed rounds in a little bit. You can see that uptick in terms of funding. The chart on the left, the blue line, yes, the amount of money going in, because it's seed round, it's smaller checks. But if you take a look at the chart on the right, look at that. The sheer number of deals happening at the seed round is immense. It's just wild, the growth that startups are seeing on the continent. So again, this underscores the message that it's a fantastic time to build a company in Africa today. And if you're building an AI company, then you're already ahead of the pack, because what you're doing is building a product that teaches itself how to be a better product. I'm sure you all know this. That's why you're all part of the Data Science Nigeria community. And just, to show that it's not just the investments, but also the other end, exits are happening. So if you're in it to exit your company, there's, a very good chance that you could be on some future version of this list. Your company could be on some future version of this list. I mean, look at Wald Remit acquiring Sendwave for $500 million. This is, this can happen, and it is happening. So this can happen to you. So be excited, get excited. And these are just some of the exits. These aren't all the exits. These are just some. I can't fit all of them in one slide. So this gives you an indication that there's a lot of activity and a lot of encouraging activity going on. So everyone should get excited about building companies in Africa. So here's the meat of the matter, right? Yes, there's a lot of money coming in, and yes, there's a good number of acquisitions going on, but how do you position yourself to get a piece of this action? And you want to go into fundraising with 2 things in mind. If you don't remember anything else from this talk, remember this thing. You want to go into those conversations with 2 things in mind. How do you project? How do you communicate that your business is a growth opportunity? And how do you show that you've minimized risk? These are the top 2 things on the minds of every investor. So everything you talk about should communicate one of these things. Everything else is either details or fluff. So be very conscious about everything you put out there to a prospective investor. Are you communicating that your business is a growth opportunity? Are you communicating that you're minimizing the risk? And you can do this a number of ways, right? So in terms of growth opportunity, you want to show this through the problem and through traction. As far as problem goes, the market size. Nobody wants to invest in a company that's solving a problem for a shrinking market. That makes, as a founder, why would you even want to get into that space, right? It doesn't make any, it's not attractive. You also want to be able to show if you can show that you're building a product for a new market, then you can very easily answer the question of why now by showing a confluence of trends. So these 2-3 trends, pandemic, people working from home more, people going to school more, people using the internet more, trends, right? If you can show the convergence of trends that creates an opportunity and that opportunity is likely to continue to grow, that's a really strong position to be in. And that's where you want to be. As far as traction, there's a number of ways, right? You can show this through signups, through letters of interest from prospective customers who are saying, okay, you know what, we love what you're building. We love what you say you'll build. And if you can build it and it does what you say it'll do, we would pay money for it. And to that effect, here's a letter of interest, right? So if you can go and collect a bunch of those, it'll help your fundraising prospects. But again, the best thing you can do is to generate revenue. And if you can generate revenue and especially be profitable at an early stage, oh man, there are very few things that are more appealing to an investor than that. As far as the minimizing risk, you can show that from at least three ways: through the team, through a defensible product, and through showing capital efficiency. For the team, as an AI company, this is pretty straightforward. You want 2 or 3 founders executing the roles of a domain expert, a data scientist, and a machine learning engineer. And what I'm seeing increasingly so is that the last 2, the data scientist and the machine learning engineer role, are executed by one person. That's a really strong CTO. If you can find them, and I'm sure that they're out there in the data science Nigeria community. So if you're not that person, find one quick, because they're extremely rare and they're heavily sought after, and they're really strong team members to have. As far as the product, you want to build a product that solves a full stack industry problem that requires subject matter expertise. Again, this is where the domain expert comes in, and uses proprietary data and AI to drive the core value proposition. Again, all of this. A product that teaches itself to be a better product is infinitely better, or at a certain point becomes infinitely better than a product that doesn't, because you can code scenarios into a product, but only a limited number of scenarios, because you can't really imagine all possible scenarios. But if a product that teaches itself can learn how to be a good product to solve a problem in a scenario that you haven't thought about. So that's why you want to make sure you use AI at the core to drive the core value proposition. And why you need a domain expert is you're solving problems and you're not doing what's already being done. Otherwise, you're wasting everyone's time. What you're looking to do is take a very out-of-the-box approach. But the benefit of having a domain expert on the team is that person understands how the box works, right? So what the gaps that exist. The gaps in the value chain. The problems that the industry or that vertical faces. That person brings a lot of insight into the product, and that could help the product win. And finally, capital efficiency. You want to show that you're aligned with the investor. You're building the product today. Let's say, it's an idea, you and your buddy, you've come up with this great idea to build this really cool product. Doesn't exist yet. But over the years, it's probably going to take you, $25 million to build it to a point where it's, a really juicy company. The last thing you want to do right now is waste anyone's time by trying to raise $25 million. Right. So this is where aligning with Milestone comes in and being capital efficient on a number of different levels. So you think about fundraising in terms of milestones. Where is it that you need to go to next? Right. And that's what you raise money for. So if you're starting with an idea, what you need, the next goal is, how do I prove that, how do I validate that this is something that people will pay for, right? And that takes 3, maybe 6 months. Maybe you raise a bit of money and bootstrap it, just to so you can survive on that for the next 3 to 6 months while you try to build the product and hunt down one customer who would pay you $50,000 a year, and that's enough proof to move on to the next stage and say, okay, now I want to scale this, over the next 12, 18 months. I want to raise a seed round, and that could be 100 grand, 200 grand, $500,000, $1 million, whatever it is, depending on your business, to help you hit that next milestone. And when you hit that next milestone, the next milestone is, at that point, is to now raise a Series A. And to do that, you need to be doing at least $1 million in recurring revenue, right? So you want to be thinking about the next milestone and what you need to get there. And that's how you decide what to raise, right? Because otherwise you get laughed out of the building, or nowadays laughed off the Zoom. So that on you. And so just to recap very quickly before I think we can take some questions, a little bit about me. Ripple Venture Capital managing partner. My DMs are open on Twitter. It's probably the best way to reach me. So definitely shoot me messages, and I'll respond. We talked about Africa's funding landscape and why now is a great time to build. So build. Don't worry about failing. Just build, test the market, test your product. If it's not working out, pivot, figure it out. Keep talking to your customers, let them inform you about what they want, and build that product that solves their problems. We talked about some funding sources. The best one, the most attractive one, is generating revenue directly from customers. So you want to put yourself in a position to get to that point as soon as possible. And then we talked about what investors look for and the primary things: growth opportunity and minimizing risk. All right, thank you. And we can take questions now, I believe, right?
Okay, team. We expect you to love the session. I can see comments in the chat window saying that you love this session. Of course, you should love this. The floor is open to ask questions. Please ask in the chat window. There are many terminologies related to fundraising, bootstrapping. These are things that we would like you to know. That's why we have this session. Okay, so I think we have a question from Joshua. He says, talking about same combination. Okay, now it's flying away. I'm trying to scroll back. Okay. Okay, so Joshua is asking, he said, okay, now I can't find a question. Everyone is replying so fast, but I know it's about team combination.
Okay.
Okay, he's asking if rather than teams having subspecialties, can roles be merged? Joshua, I hope that's what that means. And challenges faced by startups, especially in funding. Can any of the roles be merged? Okay, so he's asking while the team is trying to grow, can teams be merged? Like, can you be the receptionist with every other role? Can you be the machine learning engineer and the DevOps engineer together? Joshua, I hope I asked your question right. You can reply me in the chat window if I asked the right question. So Osayi will answer that.
Yes, yes. The short answer to that is yes, absolutely. I think I even gave the example of I'm seeing increasingly that the data scientist and the machine learning engineer are one person. That wasn't always the case. For the most part, that's not the case today, but increasingly so, that's the case because founders are finding that investors are really drawn to that. When there's the CTO who's both the data scientist and the machine learning engineer, just one person handling that is really, really attractive. And of course, sometimes the domain expert is the data scientist, right? And then machine learning engineer is another person, or the other way around. It doesn't really matter. As long as you have those roles being executed by at least two people, you're fine.
Okay.
I hope that helps.
Okay, Joshua, if that answers your question, please reply in the chat window. I can see someone raising his or her hand. Kindly ask a question in the chat window. Michael, are you online? Okay,
Yeah,
so Michael is coordinating the Q&A. The last question, okay, there's a question here. Based on my research, most accelerator programs they usually request for an MVP. Is this an important factor before one can enroll in one? So this person is asking about accelerator programs.
Yes, that's correct. Some you apply and then you end up and you pivot and you change, you're building something completely different than what you applied with. It happens. I mean, an MVP is, you can make it fairly simple. I mean, you don't want to apply with just, oh, here's my idea. Many people can do that, and then how do they pick who they bring into the program? So it helps to show commitment, to show that you're serious about taking this company forward, to at least have an MVP, because you separate yourself from companies or people with just the idea. So if you can build one, it helps.
Okay, thank you very much, Osayi. There's another question here which says, is it good to take a survey before building a product? This person is asking in the area of, should you do your research before you go ahead and start building?
Yes. Yes. I mean, you don't want to build a product for yourself, if that makes sense, right? So you want to make sure that it solves a problem. So if you need to go, if you're building a product, say for, let's call it an HR, process automation product, right? You want to go talk to heads of HR at as many companies as you can and get a sense of the problems that they're facing and try to, refine the set of problems so that your product is very focused on solving that stack of problems that they face and solving in a very compelling way that they walk you straight up to the CEO's office or the CFO's office to say, write this company a check. We need this product. So yes, absolutely, surveys are great, but in-person discussions are better.
Okay, thank you so much for that very detailed answer, Osayi.
Yeah.
This person here is asking another question saying, I would like to ask if it's compulsory we build a product, or can we have a startup offering data services to its customers? I think this person wants to know if you need to maybe have a tangible physical product, or you can just start with a service related kind of business and you can scale up into some definite products after that.
Yes. I mean, yeah. Most products are services. So if you want to start with maybe a simple product, and build it out from there, sure. If it's a very if it's a product that solves a very specific problem, absolutely. And then build it out to solve adjacent problems. That could be really attractive as well. So yes, you don't have to build the product from day one. That MVP we spoke of a couple of minutes ago, that's your MVP right there.
All right. Thank you so much for shedding more light into that. And I know a whole lot of my young startup friends are always asking this question: how do you trade your equity for your business for funding, and what do you need to know when you get to that stage in terms of ownership, trading equity for funds, raising capital in the stock market, things like that. How do you manage that process? A whole lot of young startup guys are quite naive when it comes to that, and they sign any contract just on their table, and at the end of the day, they get forced out of their business. So how do
Mm,
tech startup guys
yeah.
avoid that pitfall?
Yes, I have quite a bit to say about that. So one, raising money from the stock market, many years down the line, and at that point, you will have advisors who can help you a lot more than I can. So the Goldman Sachs of the world, that's their bread and butter. But if you're talking about an early stage company looking to raise some money right now, at the pre-seed round, if you just have an idea, you haven't built anything, you don't have one customer, and you want to raise a bit of money so you can survive for the next 3, 6 months, 12 months, maybe build this out and get 1 or 2 customers so you can then go raise your seed round. At the pre-seed round, what's most common is a instrument called a SAFE, simple agreement for future equity. It's without going into too much detail, you could look that up. Y Combinator has a very popular version of, I think they founded this. Or the YC Safe is very common. It's very popular at this stage. And no one at that point is really talking about equity because no one knows how much the company is valued. You're really an idea, right? So there's no real way to value the company at that point, and that's why it's an agreement for future equity. So they give you some money, with the hope that when you raise money later on, raise what's called a priced round. So people are buying shares of the company, so investors are buying shares of the company at a fixed price. Then they can now, depending on the agreement, get some of those shares, right? So that's for the pre-seed stage. For the seed stage, the seed stage is typically a price round. Some founders and investors use safes as well during the seed round. I personally, Ripple VC uses a Series Seed, so priced round. Series Seed is a crowdsourced document that is just a standardized term sheet, standardized agreement for investing in companies. And as far as what equity you should be thinking about at the seed round, data shows seed rounds are about 20% equity. So you can go a little bit below, a little bit above, depending on the position of the business. If it's in a really strong position, if you have a successful founder as one of the co-founders, if the co-founders have maybe exited businesses before, then you could probably raise your money at a lower, given a smaller bit of the company away, right? And also if you have really strong advantage in terms of market access and customer base, all of that, it all depends, right? So it's a range. Let's call it 15 to 25. I wouldn't go over 25. Some investors push the companies to do a seed round at 30%. I'm not quite sure why. I think that's extremely short-sighted, because what happens is that at every subsequent round, you're not given out, but you are given up some equity of the business. So at the Series A, that's 25%. right? 20-25%. That's another chunk gone. At the Series B's 15%, say, that's another chunk gone. At the Series C, if you can do 100 million Series C, that's 10% of the business gone, right? So, and at that point, you don't want, so those investors who come in and say, no, this round, I want to invest in a way that this round is 40-50% of the company, that's extremely short-sighted, because they don't leave a lot of meat on the bone. And what happens is that subsequent investors see this and say, oh, your first round was 40% of the business. That's not a lot. I mean, you haven't left out enough for me, right? You haven't left enough for investors who come after me. So it's unlikely investors after me are going to come in. So I'm just not going to come in at all, right? And then the business just either zombies on or dies. So you want to use data. There are reports out there that show this. So it's not like you're pulling numbers out of thin air and the investors pulling numbers out of thin air. Yes, there'll be a negotiation, but it's good to start with data. So if a lot of data has been aggregated and the average for seed round is 20%, that's a good starting point. If you're in a really strong position, you can go lower, but I wouldn't go higher than that.
All right. Thank you so much, Osayi, for shedding light. I believe everyone is taking note of this in this session. It's very interesting thoughts shared there that do not go beyond 20%. He has mentioned that the range in terms of seed capital for the seed stage is between 15 and 25%, but he will advise that you go for 20%. Somebody asked a question here, says, as regards building a startup on robotics, has your VC firm ever funded one before? If so, how did it pan out for them?
No, Ripple VC has not funded a robotics company yet. So if you're thinking about building one, especially in manufacturing, that'd be really exciting, because I am looking for that.
Okay, all right. Then we have another question here. I see questions like this a lot, but I think Osayi can share his perspective to this. How can I protect my ideas from being stolen in the price for searching for investors?
Oh, what was the second part?
How can I protect my idea from being stolen? I think the person is just saying, how do I protect my ideas from being stolen in the search for investors, or maybe in pitching to investors and all of that?
Yes. So I wouldn't worry about that at all. The odds that your idea has already been heard by an investor is 99%. So I wouldn't worry about that. I think that's something that too many founders get distracted by. And some even go as far as wanting investors to sign NDAs. That wouldn't work. You just get left off the Zoom call. You don't want that. What you want to focus on is execution, and execution at a blistering pace. That's the best way to defend your position. Be it growing your market, be it talking to investors, everything full speed, right? That's the way you get ahead. Because at any point in time, as soon as you start building something, you're probably not the only person with that idea. Someone else somewhere has seen it. And that person, if they're aware of what I'm saying and knowing that, wait, there could be this other person, this other guy, this other girl building a similar company, they're going to want to go hard, right? To speak to investors, to speak to prospective customers, because they know that once they lock those customers, once they lock those investors, they get the spotlight, right? They're executing. And if they're executing, they're going to win. So that's where you want to be. Don't worry about your idea getting stolen. There's no unique idea. That's a myth, right? There's no such thing. Look at all the big tech companies. They all compete with each other. All the other tech, any company you probably know competitors of that company, right? It's the same idea, but it's execution. That's what matters.
Okay. All right. Thank you, Osayi. I think that really hits the nail on the head. because everybody could have the same idea you have, but what makes the difference is the execution. What kind of process are you going to put in place to execute that? And nobody can. You're not going to be revealing that at that stage of that process. I think this question also relates to the question Osai just answered. The person said, "Can you talk about the place of intellectual property for disclosure of your ideas if it's stolen?" I think that has been answered by Osai.
Yeah, yeah.
Okay, it says, "Is there any ideaton program you can recommend?"
Is there any
Ideaton, like hackathons or
yeah.
ideaton programs where you can go and pitch your ideas and maybe funders or investors are there?
I think one of my favorite pitch competitions is Hello Tomorrow. So I'd encourage people to take a look at that. Hello Tomorrow. I think they're a Parisian outfit. I think they're in Paris, if I remember correctly. But anyways, Hello Tomorrow is the name of the group. And they're focused on deep tech. And of course, there are lots of AI companies pitching there. And they're always happy to see companies from Africa. So if it's something that interests you, definitely reach out to them. I would love to see more Africans on there as well. And just to the previous question, yes, NDAs, forget about those. If you think that if you think that it's worth writing a patent, getting a patent for, sure, go ahead. I can't really speak to the value of those, which is crazy because I used to commercialize technology when I was doing my MBA. That's my job. But just execute. Don't worry about all of that. Just execute, build the business. Once you show that you're the best opportunity for investors, you'll get way more money coming at you than you need, right? And you'll grow and you'll win. That's what you want. You want to win. So don't get distracted by these other things. Stay very focused, laser focused on how do I build this business? How do I get the best people on my team? How do I become the best solution for my customers? How do I make my customers the happiest customers on the planet? If you can do that, investors will find you, which is actually a good place to be. They won't come looking because you have a patent. Nobody does that.
Okay, wow, that's really a great answer to that. I think we don't have any new questions. So guys, I think with what Osaya said, keep your mind focused. I can see a whole lot of people still talking about this protecting your idea, and it's still going on in the chat room. But keep your mind focused. He has stressed so much on that. Beyond just somebody trying to steal your idea, stay focused on execution. And like he mentioned, to stay razor focused and you build a great business, investors will come running at you with funding. So, okay, then he also mentioned for the person asked about idea that you can be part of. So just check out Hello Tomorrow. Somebody has posted the link. Thank you very much for sharing that link with anyone interested. If you want to pitch ideas, I think you can just go to that link. So I think I have a question I would also like to ask here. Because Osai, a whole lot of guys on this program are young guys, maybe in school, out of school, just starting their businesses, and they want to register that business. How about 2 or 3 of them might come together to say they want to start an AI, data science related kind of business or build a product around this. How do they assign shares of the business to themselves in this kind of scenario?
Very, very good question. So it's easier for investors in terms of believing that you're all super committed. And I'm sure there'll be a lot of material about this online and such. But if you're all going to be putting in the same amount of work, make it equal, right? If 1 or 2 are going to be doing less, at least so the minimum to be considered a co-founder is 10%, right? 10% of the business. So figure out how much work you guys are going to be putting into the business and start there. And then if it's okay, if would one person be putting in some money, and then you can say, okay, this money, how many shares of the business does it buy, and then that person gets those additional shares, if that makes sense, just to keep things fair. Because what you don't want to do is create a situation where you say, okay, yes, all, let's say 3 of us own 33%, or let's say 2 of us own 50%, but you just sleep all day and I'm the one who's doing all the work. That doesn't look good, right? And that just basically setting yourself up for a breakup. But if both of you are going to be doing your thing, one is doing the technical bit and one is running around trying to get some deals done, and you're both, on this 247 every day, 50-50 is fair. If one of you is bringing in some money, then that one with that money can buy shares, and that person owns a bit more shares than the other person. That way it's fair. That's how I like to think about it.
Okay. And I think, guys, I believe we all got this. So before you go into any share allocation for your startups, look at what each person is bringing to the table. As Osayi said, who is bringing in more? Are you going to be doing the same thing? Are you going to be putting in equal efforts? That's when you can split 50-50. Or if you are 3 of you, you can do 33% each before when you go ahead to register that company, because that question is going to come up. And when it comes up, I think with the insights Osayi has given us, we can take that knowledge and we know who gets what in the business, and who gets the highest share, who gets the controlling share, or who's just an investor that just want to put his money in exchange for some shares and not do anything and just watch the business grow. Okay, thank you so much for that. I think somebody will ask the question here. So I would like to ask this question, Osayi. What do you look for in a pitch deck? So if you're listening to startup founders pitching to you, what are the things you look out for?
So I look out for the things that I said investors really look out for. Is this a growth opportunity and are the risk minimized? And I look for them along those, especially those 5 items: the product, the team, your traction, the problem, and how capital efficient you are. And all of these things. And I also definitely look at your business model, because I want to understand how you make money and if you're on track to, or what that trajectory could look like. Understanding, how much a customer is paying you a year, understanding the size of the market and how that's growing, and then taking a look at your unit economics as well. So there are a bunch of different items, but really at the end of the day, it's this is, when I mentioned that outside of those 5 things, it's either details or fluff. There are some other details that I would want to see, like your unit economics, your business model, yeah, and those other things. So those are the items that I would want to see.
All right.
And
Okay.
I'm hoping you can share the deck with anyone else who wants to have access to it. And then, so in case some of them didn't capture all of that.
Okay. We will share that. We'll share that with all the participants of this session, and we're also compiling all the slides from all our speakers for this 3 days bootcamp, which will be uploaded on a drive, and all our registered participants can download for the entire bootcamp session. Thank you so much, Osayi. I think we'll just take 1 or 2 questions before we go. I know time is almost up. In summary, what you said last was what do you look out for? The person asked about what are the things you look out for in a pitch deck. You mentioned something around growth opportunities, risk minimized, the product, the team, the problem it's solving, how efficient is the business, and the business model. I think that answers it perfectly well. I think final questions. Does anybody still has any question before we close? Okay, I would like to ask this question. So, at what point does one start thinking of how to exit a business? Maybe you want to pursue a bigger opportunity and you want to sell off.
Whenever you reach that point is a good point. You want to position the company to be acquired. There's a saying that goes, companies are bought, not sold. So if you're selling the business, it doesn't look good. What you want to do is be in a position to be acquired. So through one of your, say, your corporate clients, right? If you're solving problems for a bunch of corporations in a vertical and you're growing, typically what an investor would do is get one of those or more those investors to invest in it, in a later round, say your Series A or Series B, right? And what that means is that they now have access to the performance of the company. And it will get to a point where those investors, those companies don't want their competitors benefiting from your product. And they'll want to write you a check to buy you out. So that's a position you want to be in, right? So that's a really good question, because this also ties into what you look for in an investor, because you don't want an investor who's just giving you money, because that's commoditized, right? You want an investor who brings way more value than money, because these connections, these access to markets, these access to partners and corporate customers are infinitely more than whatever check they're writing, or not infinitely, but they're significantly more than the check that they're writing. So you want to be thinking about that. That's a really good question. You want to be, if that's, what you want to do, and not every founder needs to take their company into IPO. If you want to do it for a few years and check out and go start another one and do that for a few years and check out and go, that's okay. That's fine. As long as you build a company to a point where it's super appealing to a large corporate to see that not only is this a attractive to them and they don't want their competitors benefiting from it, but they also don't want you to come compete with them if you're growing super fast. So position, again, execute, and good things will come.
Okay, thank you so much, Osayi. I think that answers it, because I saw one of your slides in your introduction when you talked about companies that were acquired in Africa, where you talked about Paystack being acquired by Stripe for
Right.
$200 million. I think that's the highest so far that we've seen in Nigeria.
Oh, in Nigeria, I think that's a
Yeah, in Nigeria. So it really went on. It was on the news for days. Everybody was celebrating that young startup, 5 years, and they're exiting at $200 million. It was in fact, I took my calculator that day, started converting to now, like, wow, this is $5 billion. These guys they've blown, as we call it in Nigeria. Yeah. but that's very good. And just to recap your points for in case some people missed that, is what Osayi said is position your company to be acquired, not sold. It puts you in a better position. And what you want to do is to put yourself in that position where you can be acquired. You can get much more value in that way than saying you are selling. And I think I've also learned from that. I will stop saying sold. I will say acquired. I think that puts you in a better position to your investors. So I think we've come to the point where we should close. I would hand over back to my colleagues, Leko and Wura. I want to thank you so much, Osayi, for taking out time for
Yeah.
asking these questions.